Welcome back, everyone. My name is Michael LeBlanc, Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks for joining us here again this week for Last Week Today, where we cover off everything that we saw in the markets, everything we see up and come in the markets, and talk about portfolio strategies that you can take advantage of or protect, depending on what's going on in the general economy out there. And with that, as always, keep in mind, everything we cover on here is for information purposes only. Do reach out to us at mikeonmoney.com if you have any specific questions, you want to talk about your situation and how we might be able to help or at least point you in the right direction when it comes to your portfolios and investing, or at minimum, do your own due diligence before implementing any strategy in your investments. So with that, as we always touch a bit on COVID-19, these are getting shorter and shorter, thankfully. Basically, here in BC and across Canada, province by province, we're basically seeing the restrictions being lifted, whether it be mask mandates or the passport mandates are all pretty much in process, if not somewhat lifted, depending on what province you're in. There's still international rules, so if you are starting to travel, as always, double check your destinations, double check the requirements for getting there, but also really double check the requirements for coming back. They tend to change, and someone who has traveled recently, the chaos we saw in the airport was people unprepared. So, whether they didn't have their ArriveCan app properly downloaded, or, didn't have the test done. They thought that they had been lifted or so. Just make sure you double check any travel requirements, both for your destination and all your destinations, if you have layovers anywhere, but also your return, and not just current, but try to stay on top of it, because as we've seen in the past, they can change on the fly, and you might find yourself with some out-of-date data. And if it goes the other way, then that can be a concern. We'll talk a little bit about it today in as far as economic news. We are seeing the coronavirus cases climb in China again. We're seeing more restrictions being put back into place there. They have a pretty strict zero tolerance strategy in China to control or maintain the breakouts to they're limited the regions anyway. But with that, in the rest of the world so far, it's pretty much been heading the other way as of right now. So we'll keep an eye on that. What are we watching for this week? Well, before I get into any of the economic news, of course, we're watching the Ukraine situation. We're going to talk about not just that situation, but the impact on the markets throughout today's presentation, because it is having an impact, and this is going to have a bigger impact in the coming days. So we'll keep an eye on that. But what we're looking at this week definitely is the producer price index for February. The FOMC meeting is this week on interest rates. Canadian housing starts for February numbers are coming out. So all those are going to lead into kind of what our expectations for the markets are over the next week. Stock futures have been pretty rocky, or the stock market has been a bit rocky. They were off today just on that rise in cases in China, obviously still coupled with the concerns around the war in Ukraine. And then, of course, we have interest rate hikes. Do you remember back when our biggest concern was inflation and interest rate? And now we have COVID, interest, inflation, war, all going on at the same time, all affecting the inputs and outputs of our modeling and what we see coming up in the market. So we're going to dive into that quite a bit today. The Feds, as I mentioned, are kicking off a two-day meeting where it's expected we're going to see a quarter-point rate increase. We saw Canada do it already. We're looking at the U.S. to come out roughly the same. They're going to be looking really closely at the wholesale inflation data to be introduced on Tuesday. And again, we're just at the early stages of the spike in inflation that we're seeing out of the Ukraine situation. So all this is going to be discussed in a lot of detail over the next couple of days. And we'll see how that plays out. Hedge funds slashed their oil positions amid extreme volatility. So as we talked about last week, we definitely saw oil spike, largely just on the Russia-Ukraine situation. Of course, countries around the world cutting off their purchases of Russian oil, which means the supply fell off dramatically. Russia is a big producer of oil. So we saw a spike in those prices. That's come off. We've seen oil dip below the $100 mark. But that doesn't mean necessarily oil, as far as an investment goes, is over. Just that spike has pulled back. We might see it spike again. And there's a lot of unknowns still when it comes to Ukraine and Russia, but at the same time, prior to the Ukraine-Russian situation, we were going into a bit of an energy crunch. We were already seeing the oil prices ramping up and profitabilities for those companies ramping up. So that trend's not likely to change. And also, even if there is a resolution to the Ukraine-Russia situation, that doesn't mean countries around the world are going to turn the tap on to Russian oil overnight. In fact, likely solution will be other oil from less than friendly places, but more friendly than Russia right now. Obviously, the Ukraine crisis has hit the metals out there. The London Metal Exchange has taken off. We've seen, not just gold and precious metals, but things like nickel, which is a lot of production coming out of Russia and Ukraine. All that's been turned off. So we're going to see those spikes in those metals, the base metals, until we get some sort of resolution or some sort of insight as to how all this is going to play out. With that, as I mentioned, the Fed are dealing with a very complex trifecta. In December, of course, they were focusing on the inflationary numbers and how that was going to affect the interest rate hikes. And the markets had pretty much determined exactly what those interest rate hikes were going to look like for 2022 and where they were going to be spaced. And all that goes out the window. So for the next 2 days, it's going to be really interesting to listen to the language coming out of there, how this war is affecting things, how they perceive the pandemic, right? Is the Fed going to be worried about what's happening in China? Are we worried about another wave? I can't remember what wave we're on anymore, but another wave, or is it going to be strictly just inflation and war-driven inflation, and how they're going to react to that? U.S. consumers, have lifted a little bit. Their spirits or their outlook has gotten better from last week as far as what they see this year. There is expectations of more cost increase when it comes to food and gas and rent over the next 12 months. They are expecting interest rate hikes, but it seems like the market or at least the market sentiment is that they've accepted that. That's just going to happen. We're not sure when and how it's going to play out, but the market seems to have accepted those facts. And in fact, we've seen the gas price spike, of course. There's a lot of talk out there, especially on the internet, about who's to blame and what's to blame. And there's probably, all different kinds of shade or different levels of where blame could be laid. But obviously the spike in price of oil has driven that up quite sharply. And of course, it's not coming down as fast as the price of oil comes back down. So, but that's typical. We've all experienced it in the last decade, where when oil, gas prices hit a new high, they've kind of got a new plateau that people accept, and they really don't go back way back down again. So probably not going to see gas prices get back to their previous kind of price and range that they were. Very likely to stay in a new higher range, not at peak levels, but new higher range. And food is going to be impacted dramatically. I mean, there's a lot of talk around grain because, of course, Russia and Ukraine are big producers of grain. Ukraine, obviously, often being referred to Europe's breadbasket, referring to how much grain they provide for bread and baked goods. In Europe, especially Canada, less affected, and US less affected. But at the same time, that's driving up the price, which means everywhere around the world, those types of products are going to increase. So we're definitely going to see that impact things at the grocery store, even more so than we've seen already. So just as we saw spikes in the oil prices, we're definitely going to see more spike in the food prices. It just takes a little bit longer to trickle through the food supply chain than it does oil and gas. So as we, just we're coming out of the supply chain issues from the pandemic, we go into a brand new supply chain issue dealing with this war, given Russia and Ukraine's contribution, especially to natural resources. The U.S. is stepping up their program to delist Chinese ADRs, which is putting a lot of stress on certain investments. So if you're investing globally, you might use ADRs, deposit receipts. Basically, what they are phantom stocks. Best way I could describe them is you're not actually buying stocks in a Chinese company, but you're buying a deposit receipt which trades on the U.S. exchange, which owns or tracks the underlying security on the Chinese market. So you buy in US dollars, it trades, easy liquidity on the US exchange, but you're actually tracking the underlying security over in China. Obviously, with everything that's going on, the global sanctions, Chinese involvement and help, or perceived help anyway, with Russia during this crisis, the US government is moving to delist those from the New York Exchange and also stop any new ones. So any funds or any ETFs or any kind of investments into those have to be unwound in those funds, or if you own them directly in your portfolios, of course, you'll want to get rid of them, because as they get delisted, then they become, you wouldn't be able to trade them anymore. So that's putting more pressure on those markets, and we've already seen those steps taken for anything Russia related as well. And I don't think we've seen the end that. That's going to continue. Biden's Fed nominee Raskin is imperiled by key Democrats opposition. So as we've seen in other things that the Biden administration has tried to put through the Senate, there's a couple of, because it is such a tight Senate, basically one vote separates between the Republicans and Democrats. They've had a couple of Democratic senators who have kind of split away from party lines in the past. We saw that in the Build Back Better programs, and now we're seeing it around the nominee for the top Fed Reserve position. Now that doesn't kill it, but it does put a lot of pressure on the Biden administration to kind of get that pushed through, or to get one or two Republicans to vote their way. So we'll keep an eye on that to see if he gets that through. And let's take a look what's happening this week. As I mentioned, the Federal Open Market Committee is going to meet for 2 days, looking at that interest rate hike, first time since 2018. So, expect continued volatility in the markets with that happening. The Labor Department is scheduled to release the U.S. producers price data to show the producer price index is expected to rise. It should jump to 10% increase following a 9.7% increase in the previous month. So that's just inflation continuing to push. There's no expectations that inflation has not gone up when we look at what the war impact has been on just those resource products. And we're seeing the 8th U.S. Circuit Court of Appeals in St. Paul's will consider whether or not to force Minnesota's Attorney General to litigate in federal court rather than state court a lawsuit against Exxon and other members of the fossil fuel industry about misleading them or downplaying the threat of climate change. So this is not something unheard of, and it's not something new, and we're going to see a lot of this when it comes to fossil fuels over the next, I would say, 5 years, as more and more lawsuits come out, whether it be around climate change, impact of those change, health. We saw very similar types of lawsuits happen in the tobacco industry when they finally came out and admitted that smoking is bad for you, and that they put a lot of effort into making people more and more addicted, make it more and more concentrated over the years, and they hid that data. So there was a lot of lawsuits around, healthcare costs and impact on society. Now we're going to see that with fossil fuel. But while that's being said, that's happening. Of course, you have companies like Exxon posting their largest profit, quarterly profit ever last quarter. So, things continue to move on for them. Other news in the US, Citigroup has expanded its Russian withdrawal, raising the prospect of some losses for Citigroup. So this is basically being accelerated by more and more Wall Street banks pulling out of Russia. You've probably seen the news, more and more companies are pulling out of there, closing operations or stopping any new business. And Citigroup's following suit with that, along with their rivals on Wall Street down in the US. And globally, of course. Pfizer and Bayer are going to maintain their services into China. Their view is that they're going to maintain humanitarian supply of medicines to Russia. Russian people, of course, are being affected by all these different restrictions that are being put into place. Their lifestyle obviously being affected by their leaders, or not just their leader, but the leaders' actions in Ukraine. But Pfizer and Bayer are going to continue with vital medicines and supplies, but they are going to pull back on non-essential spending in the country. So still impacting for their non-essential products. Chevron is ready and set to trade Venezuelan oil. So as I mentioned before, with the Russian oil supply off the market, the U.S. and other countries are looking at other places to buy necessary oil. Obviously, Canada's on that list, although Canada could have supplied all that oil if the the XL pipeline had gone through, but that was killed. Maybe that comes back, into play for future. But they're looking. The U.S. is looking to replace that Russian oil quickly. They do have sanctions on Venezuela right now that they could lift, kind of the lesser of two evils. And if they do, Chevron's ready to start accepting oil immediately from Venezuela, which would ease the supply, and that's where you've seen some optimism on the oil price as we see the price come off its highs there. Wall Street Bank's staff is about to churn. So if you're not aware, Wall Street, especially on the investment banking side of things, a large part of their compensation is annual bonuses. So whenever we have a very tight labor market like we have right now, so there's a lot of demand out there, a lot of poaching being done by competitive firms trying to recruit top bankers across the hallway to new offices, but they hold off on those opportunities until they get paid their bonus. Well, in the next few weeks, we're going to see those bonuses paid out, and as soon as they get their bonus, if they are looking at new opportunities, and if they are being lured with higher pay or better opportunity, we'll probably see a big shuffle happen on Wall Street over the coming weeks. It's happened before. It will happen again. It's just a symptom of their compensation structure happening, largely once a year. So everyone waits till after that to make some moves. Bristol and Nectar are terminating a melanoma therapy trial after failed studies. So, as we see a lot of the pharmaceutical companies having, a great year with the developments of the vaccine and increased earnings from that. Bristol and Nectar actually were working very closely into 2 late-stage studies around therapy to work on melanoma patients, and that trial failed to meet the goals that they were, or at least the expected goals. So they'll be scrapping that. So that'll hurt their expected earnings for the coming quarters. On the foreign exchange front, the U.S. dollar edged slightly lower on some tentative optimism around Russia-Ukraine peace talks. We did see some at least positive comments coming out of the talks over the weekend or late into the weekend. Now, that being said, the last couple of times we've heard some positive talks. It was all a distraction for increased deployment by Russia into the Ukraine. So we'll have to keep a close eye on that. But we did see a little bit of edging down on the safe haven US dollar and a little edging up on the euro. Not a lot though, as we continue to see, obviously that war risk being priced in. And with that, we saw the Treasury yields down, but remain at their highest point since 2019 after topping over 2.16%. As I mentioned on the oil price, we did tuck down below $100 a barrel. I think I saw around 93 a barrel this morning. Still, a big run up from late last year, and we still have that energy crisis. It's just off that peak as countries have, the fear of having the Russian supply chain off, and now kind of some optimism that we'll be able to secure other supply sources to just keep the price around that $100 barrel mark. But we continue to see more ramping up. We're seeing more travel happening. We'll actually have to see how that plays out. Travel was increasing dramatically with all the different requirements being lifted. However, obviously, especially European travel right now is going to raise a red flag for a lot of people as to whether that's something they want to entertain given what's going on, and obviously impacted a lot, or it's going to be impacted a lot by the flood of refugees into some of the European countries, as we've seen already. I think the last number I saw was around 2.8 million people fleeing Ukraine for refugee status in other countries. Gold price continues to be elevated. We saw a little bit again weakness off the top, but that being said, we have all this inflation, we have war. Gold tends to do well in those conditions, and will likely continue to be strong for the coming weeks into probably mid 2022. Again, really until we see any kind of light or potential outcome to this war, all these things are going to remain volatile. The market's going to remain volatile, as we mentioned, going into this, not because of the war, but going into this, we were expecting a volatile year. This hasn't changed that outlook, other than it's added another layer of concern that's going to have to play out. That uncertainty is going to have to play out. So be cautious. Don't chase the markets. If you see a really a strong up day, again, I wouldn't chase after that. Chances are there'll be a sell-off the day or two afterwards, to come off those highs. As always, if you do want to be more active, try to trim a little bit. Don't sell out into those green days, as we call them, those up days, but trim back a little bit and then redeploy when you see the pullbacks. That's where you'll do well in these markets. Don't expect to buy at the bottom. Don't expect to sell at the top. Just be conservative with the money. Don't be impatient to jump back into things. We are going to see volatility here. This is not going to be solved overnight. So be patient. Look for the right valuations for what you're trying to achieve. You will find them if you're just a little patient and get through this. So there is still this big potential risk of recession. We have the US Fed now, or the central banks around the world. We talked about this all last year, this vision of the supply chain, inflation, and how they were going to use interest rates to orchestrate that soft land and the slowdown of the economy without sending the economy into a recession. Well, now they have that war piled on there. So what does that mean? Will they be able to do it? More and more the consensus moving that they're not going to be able to do it, that we could slide into a recession. Very likely that recession will be very short-lived and over fairly quickly, but we could easily slide into a recession territory given everything that's gone on. So be cautious, Be patient. That goes for both your fixed income side of things and your equity side of things. We'll keep you updated as much as we can on what's going on and what we see and happening out there. But the best advice I can give you right now is patience. Look for the right values for your portfolio. And if you do move in, and again, you're not buying at the bottom, if you got in at a good value, don't worry. As I said, we don't expect this to be long-lived. We do see opportunities on the horizon. It's just going to take a little bit longer time, given the war and the uncertainty that brings to the markets. So with that, as always, visit us at mycomoney.com with any of your questions, any recommendations you have for us, anything that you would like us to take a deeper dive into, or if you just want us to help you look at your portfolio or take a look at how things are going in your investments, given everything that's going on out there. But with that, thank you very much for joining us. You can listen to this on our podcast or a replay on YouTube, as always, and we'll talk to you next week. Thanks, everyone. Take care.